Hello everyone, it's Fung here. Today we'll be talking about open-ended mutual funds. And again here, the information is sourced from the book The Truth About Money by Rick Edelman. So getting started, in our previous lesson, we were talking about the problems with investing and that the solution to them is to invest into investment companies, right? They do the heavy lifting for you, they make it affordable, they diversify, and they make it liquid. And now we're going to be talking about the different types of these investment companies. First of which, what we are talking about today here is the open-end funds, also known as the mutual funds. Then we'll talk about the closed-end funds, unit investment trusts, or also known as the UITs, and then exchange-traded funds, ETFs. But again, today we're talking about the mutual funds. So about them, well, they are currently the most popular of all the funds, and ETFs are soon going to catch up to that. And mutual funds can be used to buy virtually any investment, okay? You can buy stocks, bonds, real estate, gold, natural resources. You can buy a ton of different investments through mutual funds. And they are technically not investments, okay? They are an investment vehicle, and the investments in them are purchased on your behalf. So essentially, the mutual funds are like baskets with eggs in it. The eggs being the securities, right? Like let's just say stocks. Right. So if you're buying a mutual fund, you're buying a basket with a bunch of different eggs in them. Right. And for mutual funds, the price equals the value of what it owns. This is known as net asset value, or NAV. And I know that sounds self-explanatory. Oh, of course the price is going to equal the value of what it owns. But that's not the case for all the funds. So in our analogy again, that means the price of the basket is going to equal the value of all the eggs inside of them. Right. Hope that analogy makes more sense and breaks it down for you guys. Now, there are different kinds of mutual funds, and there's tons of them, okay? There's over 700 fund families, so people who make the funds. And there's over 7,000 funds to choose from, so it's very easy to get overwhelmed. Luckily for us, Morningstar, which is an investment company firm, right, or research firm, sorry, they put them into 8 major categories and around 88 subcategories. So the 8 major categories are government bonds, corporate bonds, foreign bonds, municipal bonds, allocation, stock, foreign stock, and target date. And now if you want to know how to understand these, we have to talk about the 4 basic concepts. So the first concept is time. This is more applicable to bonds. The reason why time is important is because it impacts safety. Because the longer you hold something, the greater risk of something going wrong with it, right? So some categories for time. There's short term, which the duration is 3.5 years, or it has a maturity, or 3.5 years or less, or it has a maturity of 1 to 4 years. There's immediate term, where the duration is 3.5 years to 6 years, or its maturity is 4 to 10 years. Then there's long term, where you have over 6 years of duration, or its maturity is over 10 years. And then there's target date. This applies to stocks or bonds, and basically you leave money invested until a certain date, right? This is for people who just know exactly what date that they're going to have that investment in. Now, concept number 2 is quality. This is more applicable to bonds again, and this is because the financial stability of an issuer impacts the safety, right? Remember the credit ratings and whatnot. So lower quality means a greater risk of something going wrong. And this is all based on credit rating. We had a whole lesson about that and how it can be sketchy, but hey, it still exists. So the categories are investment grade, which is where if you get a triple B or higher. And then there's speculative grade, where you get a double B or lower. Now the third concept is size. This is more applicable to stocks, and it's essentially the size of a company's value, right? And you're going to hear the word cap a lot, and that just means capitalization, which is the market value of the company. So to calculate the cap, it's just the outstanding shares that the company has out there to investors times, like multiplied by the current stock's price. So very simple math, right? Let's just say there's 10 shares out there and they're worth $5 each. That means the company's only worth $50, right? That's just the capitalization rate. That's a very simple example. So there's different categories for the size. There's large cap, which are the largest companies in the world. They're much less likely to go bankrupt than other companies. Of course, it's still possible for them to go bankrupt, right? But they're much less likely. There are mid cap, which is when companies are worth 1 to 8 billion. Again, these informations are from 2010, right? So it could be outdated here. There is small cap, which is when companies are worth less than 1 billion. And typically for small caps, they grow faster than larger companies, but they're more likely to go bankrupt. Okay. Next, the fourth concept is style. This is more applicable to stocks again. This is because companies have different attributes, different styles. So different categories versus value. This is when the stock price is below the company's worth, where it's growing slower than what the company's worth. And these typically pay dividends and offer more reliable performances. Or there's growth stocks, which they have faster growth than the value stocks. And this is because they're typically in expanding industries. So of course they're growing really quickly. And the performance here is more erratic because you don't know, they're not as reliable than value. There's blend, which is a fund where it has a combination of both value and growth stocks. And then there's allocation, where the fund has a mix of both stocks and bonds. So recapping everything that we learned, first that mutual funds, they can be used to purchase almost any investment, right? And that there's tons to choose from, but these are sorted by the Morningstar categories. And then we learned the 4 basic concepts, which are time, quality, size, and style. So that's it for the video. Thank you guys for watching. Like, subscribe, do what you will. You guys are not obligated to do so. And I'll see you guys in the next one. Peace.